Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. We have a lot to talk about today, continuing a lot of the themes that we've actually been discussing over the last few months, but we're watching the markets continue to inch higher despite a lot of the naysayers. Every single day the markets seem to be making new highs, and this is taking place in spite of the many analysts and economists that continue to warn about pressures from Europe, continued high unemployment, etc. But this market is continuing to inch higher. So the question that everybody has, of course, is can we really confirm that this rally is for real? And some of the factors that we look at, as we've discussed in this show before, there's two main factors that you look at, or two just basic factors that you look at to confirm whether or not a rally is actually real. One of those is that bank stocks continue to increase in value, and the second is that interest rates continue to rise. And here we have two quick charts showing this. Number one, this is a chart of the XLF, which is the financial ETF. And it is showing, this is a 1 month chart, it's showing that after the Dow, and the S&P both bounced on their high, that the financials continued to rise in value. The broad financial index continued to just jump up in value. That's a very positive indicator confirming a rally. The second, of course, is interest rates. And I feel like I'm beating a dead horse on this one because we discuss it week after week. But here we're looking at the TNX, which charts the 10-year Treasury Index. And you can see here, this is a 1 year chart again, that over the last couple of days, interest rates, especially the 10-year Treasury, has continued to inch up. That's a very positive indicator in showing that, that this rally might be for real. So even though a lot of analysts feel that equity markets are no longer climbing that wall of worry, and the wall of worry, of course, is what we talk about when we say that we can't believe that the market's going to continue to rally because of the risks in Europe, because of all the other negatives that are going on. The market doesn't seem to be climbing a wall of worry anymore. It seems to just be pouncing forward. And the economy seems to be absorbing all of the pending fiscal tightening that might be coming down, or will be coming down the pike over the next couple of months. So, to use another cliche, you really can't fight the Fed. And the Fed, over the last several years, has been saying interest rates are going to stay low. We're going to force you to take risks. We're going to force money into the market. And it looks like it might actually be happening. So if you're in cash at the moment, you're actually achieving an effective negative rate of return. So that is hopefully, what the Fed is intending and trying to push money back into the market. So, as we look at all these factors, hopefully positive factors, and as we keep achieving new highs on a daily basis, of course the question remains, should you jump in now if you're sitting in cash on the sidelines? Should you chase the market at this point, or will there be a pullback that will give you an opportunity to invest at that time? If that's the case, if it's not the case, do you want to wait out the storm? What opportunities might present themselves? And what does this latest trend mean for your financial plan? Given all the factors that are going on with this market, what does it mean not just for your portfolio, but for your overall financial plan? So we'll be right back in just a second to discuss these continuing themes and what it means for your portfolio and your plan going forward. Please stick with us. We'll be right back. Welcome back to Money Matters. We've been discussing a few trends in this positive marketplace that we're finally encountering and what that actually might mean for your portfolio and for your financial plan. The biggest trend that we've been talking about, of course, is that rates are increasing. And again, I know I sound like I'm beating a dead horse, but this has a broad impact across the market as well as your financial plan. So let's take just a brief look for 1 second. We looked a minute ago at the 10-year Treasury, and as we showed before, it was starting to spike. But let's look at this chart here just really quickly. This is a chart of the 30-year Treasury, and this is a 3-year chart instead of the monthly chart that we just looked at a minute ago. And you can see that interest rates on the 30-year Treasury are continuing to inch back up again. But as you can see, we're a long way from where we were even just 2 years ago. So, as we discussed before, of course, there's an inverse relationship between rates and prices, and experts are warning us now that rising rates would actually cause larger losses than they have in previous periods and times when interest rates have risen, because rates are already so low, and thus there's, of course, less cushion to soften that loss of principal. So here, when we're looking at the possibility of potential doubling in rates in a very short period of time, there's a lot less cushion now to soften that blow and the loss of principal as rates go up. So if you're holding bonds, this actually creates much more stress than it has in previous periods. In fact, just as an example of how little cushion we actually have, experts anticipate that a 1% rise in aggregate bond rates could actually lead to a 4 to 5% decline in prices. That's pretty significant when you consider how far we are from rates being only about 3 or 4 years ago. I mean, for example, here, rates could double over the course of the next couple of months potentially, in which case we'd be looking at a potential loss in value of bonds, treasury bonds, investment grade specifically, looking at a loss between 12 and 20% decline in bond prices. So that's pretty significant. So the question then, of course, is what does this mean for your portfolio? And number one, the first thing that you're going to want to look at is within your fixed income portfolio. It means that it's time to consider reducing or at a minimum absolutely reconstructing your fixed income allocation. So for the first time in decades, and this is really interesting, I read this in an article in Investment News, in a February article in Investment News, large investment firms, the large brokerage firms, are actually revamping their strategic asset allocation models, which are of course these pretty pie charts that you've probably all come to know and love. These strategic asset allocation models, they're revamping them for the first time in decades to underweight government bonds and to actually reduce the fixed income allocation in a lot of these portfolios. It's the first time this has happened in decades. A lot of these portfolios have been structured the same because, of course, general knowledge had always been that if you have a good asset allocation, a standard asset allocation, a risk-based asset allocation, that you would perform well over a long period of time. That, of course, is, that mindset is changing somewhat, and so the big brokerage firms are actually changing and revamping this fixed income allocation in a lot of those portfolios. So depending on your risk tolerance, that allocation may be reduced only slightly, or it might be reduced significantly, but at the very least, it's also being reconfigured. As a lot of these bond analysts are now favoring credit risk versus investment rate risk. Because when we look at bonds, there's issuers for bonds, and those issuers have credit risk, but then you also have interest rate risk. If interest rates go up, then the value of the bonds go down. So we're looking at two very distinct factors, and right now bond analysts are saying that they favor that credit risk, the possibility of a default in credit, versus the increase in interest rates. So that leads us to the second consideration within this fixed income portfolio and within your portfolio, and that is rethinking the composition of your fixed income portfolio. So here are a couple of the different aspects that you might see, or a couple of the different assets that you might see within a fixed income portfolio. Of course, you might have government bonds. You might also have emerging markets bonds, intermediate bonds, high yield bonds, inflation protected bonds, etc. There are a lot of different types of bonds out there. These are just a few flavors. But again, this is all within your fixed income portfolio. So if you're getting out of government bonds right now, where might you actually look to put your money? One place, of course, might be high yield bonds, another, which is also called junk bonds. Another would be bank and or floating rate debt, and then another might be emerging markets debt. These are three of the areas that a lot of analysts, a lot of bond analysts are looking at right now as good replacements for government-based debt, because of course most allocations should include some amount of fixed income, whether it's a 19% holding, a 25% holding, or a 5% holding. Most portfolios should include fixed income. The question is, what should the composition of that fixed income portfolio be? So just as an example, like number one, we're looking at high yield or junk. And I should put a disclaimer here. This is the First Eagle High Yield Fund. I don't have a dog in this race, so this is just a fund that I like, that I think is a good indicator of where high yield has been and where it's going. It's been a strong performing fund, great yield. So here, for example, we can see that over the course of the last year, high yield has absolutely taken off. And the thing about high yield that's interesting is you really can look at it from an absolute return perspective. The price of these bonds has likely increased, but there's also usually about a 2% higher yield in high yield and or junk bonds than there are on similar maturity bonds that are investment grade. So that's definitely an interesting place to be looking, both for yield and also for growth. The other thing that's interesting about high yield is that oftentimes it's negatively correlated to interest rates. So for example, as interest rates increase, the price of high yield bonds might also increase with rates rising. That is the inverse of what you would expect. And the reason for that is because when interest rates are increasing, typically the level of economic activity is also picking up, and that's good for high yield bonds because companies with high yield debt often have less cash and therefore benefit from that market increasing. So it's a fantastic place to consider as an alternative right now. Of course, there is more risk. I definitely want to make sure that we're clear on that. There is greater risk. Greater yield always implies greater risk, so always be aware of that, of that relationship. But high yield is one interesting place to be. There are also exchange-traded funds, et cetera, that are good alternatives here as well. So that's one spot that we might be looking. Another is emerging markets debt. And here we have an ETF, just for some variety. Here we have an ETF that's the Emerging Markets Local Bond Fund. And these are actually, in a lot of ways, emerging markets debt is going to be similar to high yield debt. It's going to perform very similar. It might actually have a greater spread over investment grade, depending on which emerging market we're looking at. It's typically going to be a few percentage points higher than investment grade debt of a similar maturity. But a lot like high yield, emerging market economies tend to be very low on cash, yet do very well as general economic activity picks up. And you can see that that's the case here. Again, we're looking at a one-year chart. You can see that over the course of the last year or so, emerging markets bonds have absolutely increased. And again, we're looking at this in an absolute return perspective, both the value of the bonds increasing, but also a greater yield than what you'd achieve in similar maturities in investment grade debt and definitely in U.S. government debt. So another really interesting place to be. So again, just in summary, whether you're looking at high yield or whether you're looking at emerging markets, there are lots of different areas that you can consider within that fixed income portfolio that you have here as part of your overall portfolio. And whether you're reducing this portion of your pie or just reconfiguring it, this is a great time to be talking to your financial advisor about how you might want to reconfigure that, what your risk tolerance is, really what your interest rate risk exposure is right now relative to your credit risk exposure. Those are some great questions to be asking your financial advisor right now. So when it comes to your portfolio, these are some things that you might want to look at, and we'll be back in just a second to take this one step further and discuss what it might mean for your overall financial plan. Please stick with us. Welcome back to Money Matters. We've been discussing how the potential rise in interest rates is probably going to have an impact on your fixed income portfolio here, and also some ideas for how you might reconfigure that fixed income portfolio to include some other areas of fixed income to replace your government bond and potential investment grade bond exposure. So what does this mean for your financial plan? Number one, it means that you need to have a discussion with your financial advisor right now, or start to do your homework if you do this on your own, regarding the real risk level of your current portfolio. And again, we were talking about credit risk versus interest rate risk, and investment grade bonds, specifically long-term investment grade bonds, long maturity investment grade bonds, are going to have significant interest rate risk, and it might be a reasonable trade-off to take that risk away and replace it instead with some credit risk where you have a greater potential opportunity for return. Again, risk is risk, so we need to consider that there's risk associated with the return, but it might be that in emerging markets and in high yield bonds and some other areas such as bank bonds that you might actually see some other potential for return. So right now, ask your advisor what your risk level is at this moment. If you're looking to alter the composition of your fixed income portfolio as a result of the current environment, it's a great time to talk to your financial advisor about that right now. Next thing to do when it comes to your financial plan in light of this increase in interest rates is consider your need for income as well as your need for liquidity. High quality bonds, investment grade bonds, government bonds, while they're more subject to interest rate risk, also tend to be a lot more liquid than high yield and emerging markets debt and other types of high yielding debt. So if your need is going to be liquidity, if you need to get out quickly, then it might make more sense to keep your investment grade debt, but keep it extremely, extremely short term, as you're probably going to yield more than you would in a CD, which of course is somewhat illiquid as well, but it's going to provide you the liquidity that you need. So consider your specific situation. What we're talking about here isn't always great in every scenario. Your situation is unique, so make sure that you consider your need for income and your need for liquidity when you're considering your fixed income portfolio. So number three, if you're nearing retirement or you're currently retired and you take or you intend to take within the next couple of years withdrawals from your portfolio to fund your retirement, you might want to rethink the percentage that you withdraw over the next few years. typically your rule of thumb is going to be that you can withdraw between 4 or 5%, some people say 3 to 5% of your portfolio on an annual basis in order to maintain that portfolio over its life expectancy. And we have a chart here of this right here. However, because interest rates have been so low, many analysts, many advisors are lowering that percentage to about 2.5% as a withdrawal rate for the first few years of your retirement if you're looking to retire soon, and definitely if you are retired for the next couple of years. That is until interest rates actually regain some ground. And the reason for this, of course, is that the lower the rate, and what this chart actually shows us here is we have probability of success, which means probability of maintaining your portfolio through your life expectancy, versus the annual withdrawal rate. And this is inflation versus, no inflation versus inflation adjusted. Right now we're in a relatively low inflation environment, so we're probably closer to this line than we are this one, but we could say that we're trending somewhere in between the two. And as you can see, your probability of success declines as the percentage of your assets that you withdraw on an annual basis increases. That makes intuitive sense. But of course, as interest rates are even lower, that means that your lower risk returns are going to be at a lower rate as well. And so the rule of thumb of sort of the 4% average or so as a withdrawal rate is being lowered for the foreseeable future over the next 3 or 4 years to approximately 2.5% until interest rates regain some of that ground. So that makes sense, and of course in a vacuum that sounds fantastic. Of course your situation might be different. It might be that you need to take a greater percentage out. But if you're doing that, if you're taking a greater percentage than that 2.5 of your portfolio, withdrawing a greater percentage than 2.5% of your portfolio, you definitely need to consider what your investments inside that portfolio are. What are they yielding? Are they, absolute return oriented? Are they growth oriented? Are they income oriented? Are they investment grade? Are they short term? Are they long term? What is your overall risk that you have there? So this is not always true in a vacuum, but as a general rule right now, you might want to consider withdrawing a smaller percentage and or looking at the overall composition of your portfolio. There are, of course, a lot of other factors to consider in this number as well, such as your mix of stocks versus bonds, your expected age at retirement, et cetera, that impact this withdrawal rate as well. It's a much larger subject, but it's definitely worth your time and consideration and a discussion with your advisor as to his or her opinion on that in your specific scenario. So these are a few things that I think that this increase in interest rates, there are a few of the areas that I think that it will have an impact on your overall financial plan, not just your portfolio, but your financial plan and your money. So that's been our show for today. We really appreciate your time. We look forward to all of your additional ideas for future shows. We welcome them. Please check us out on Facebook, and look forward to seeing you here again next week where your money matters. Thanks very much.